What if I told you that one meeting in Washington could quietly affect your savings account, your mortgage payment, and even the interest rate on your credit card? And yet most Americans don't pay attention until after the headlines hit. The Federal Reserve's next rate decision is coming. Some people will see opportunities. Others will end up paying more. The difference often comes down to a few simple money moves made before the announcement. Today, we're breaking down the 3 smartest financial moves you can make right now before the Fed's next meeting. Whether rates go up, down, or stay exactly where they are, these steps can help protect your money and potentially save you thousands of dollars. Let's get started. Section 1. Why the Fed matters to your wallet. Before we jump into the money moves, let's quickly understand why this matters. The Federal Reserve, often called the Fed, is America's central bank. One of its biggest jobs is controlling inflation and supporting economic growth. The Fed does this primarily by adjusting interest rates. When rates rise, borrowing becomes more expensive. When rates fall, borrowing becomes cheaper. Sounds simple, but the ripple effects spread throughout the entire economy. Mortgage rates react. Savings account yields change. Credit card interest rates move. Car loans shift. Business investments adjust. Even stock market sentiment can change dramatically. That's why investors, banks, and economists watch every Fed meeting closely. But here's the important part. You don't need to be a Wall Street expert to benefit from understanding what's happening. You just need to know what actions to take before the announcement. Let's start with money move number 1. Money move 1. Maximize your savings rate. If you still have cash sitting in a traditional bank savings account earning almost nothing, this is your wake-up call. Many Americans are earning less than 1% on their savings. Meanwhile, some high-yield savings accounts have been paying several times more. And here's why timing matters. If the Fed decides to cut rates in future meetings, banks often reduce savings yields shortly afterward. That means today's rates may not be around forever. So before the next Fed meeting, compare your current savings account with available high-yield alternatives. Ask yourself, what interest rate am I earning? Is my emergency fund working hard enough? Could I earn more without taking additional risk? Imagine having $20,000 in savings. A small difference in interest rate can translate into hundreds of extra dollars per year. That's money you earn simply because your cash is in a better place. Remember, your emergency fund should remain accessible. Safety and liquidity still matter, but there's no reason to let your money sit idle if better options are available. Move number 1. Review your savings account and make sure you're getting a competitive return before any potential Fed decision changes the landscape. Money move 2. Attack high-interest debt. Now let's talk about something far more expensive than low savings yields. Credit card debt. Many credit cards carry variable interest rates. That means their rates can change based on broader interest rate conditions. Even if the Fed pauses rates, credit card APRs remain extremely high by historical standards. That's why reducing high-interest debt is one of the best financial moves you can make right now. Think about it this way. If your credit card charges 20% or more annually, paying off that balance is essentially earning a guaranteed return equal to the interest you're avoiding. Very few investments can offer that kind of certainty. Before the Fed's next meeting, take a hard look at your balances. Create a list of credit cards, interest rates, minimum payments, total balances. Then focus extra payments toward the highest rate debt first. This strategy is often called the avalanche method. The goal is simple. Reduce the amount of interest working against you. Every dollar of debt eliminated today is a dollar that won't accumulate costly interest tomorrow. And if rates remain elevated longer than expected, you'll be glad you started now. Money move 3. Review your mortgage or loan options. The third move is especially important for homeowners and anyone planning a major purchase. Mortgage rates don't move exactly in lockstep with the Fed, but Fed policy strongly influences borrowing costs across the economy. If you're carrying a variable rate loan, now is the time to understand your exposure. Ask questions like, is my mortgage fixed or adjustable? Could my payment change in the future? Am I considering buying a home soon? Do I need a car loan or personal loan this year? The answers matter. If rates decline in coming months, refinancing opportunities could emerge. If rates stay higher for longer, borrowers may need to adjust their plans. The key isn't predicting the future perfectly. The key is preparing for multiple scenarios. Review your loan documents. Know your rates. Understand your monthly obligations. Financial confidence comes from preparation, not prediction. Final thoughts, 13 to 1500 hours. So before the Fed's next meeting, remember these 3 money moves. Number 1. Make sure your savings are earning a competitive interest rate. Number 2. Reduce high-interest credit card debt as aggressively as possible. Number 3. Review your mortgage and loan situation so you're prepared for changing borrowing costs. The truth is, nobody knows exactly what the Fed will do next. Even professional economists get it wrong sometimes. But you don't need a crystal ball to make smart financial decisions. The people who build wealth consistently aren't the ones who predict every economic move. They're the ones who prepare ahead of time. And that's exactly what these 3 money moves are designed to help you do. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you never miss future updates on personal finance, investing, and the economy. Thanks for watching, and I'll see you in the next video.